Hello, everyone. Welcome to CAPIS's monthly research call. This is Ed O'Dowd. Today, welcome for joining us on a series that we host every month with independent content and independent analysts. Today, we're joined again with Markets Policy Partners. These guys do a great job of kind of looking at the macro picture, macroeconomics, political policy, and kind of the intersection of the two and how it affects the markets that we all invest in. So we're really excited to have these guys on again today, particularly with the timing with the election just a few weeks away. So it's great to have them again and get their perspective on what they see and kind of helping us chart a path forward. So welcome, John.
Thanks very much. It's great to be back here with CAPIS. And yeah, we were just talking before we joined about our last call, which was in July.
Absolutely. Me, John, and Brendan, who's also joining us today from Brendan Walsh from Markets Policy Partners. We were talking about how last time it was several days before Biden stepped down and announcing he was going to run for re-election. And it was kind of like, is that really going to happen? And you guys had mentioned on the call, no, we're hearing from sources that it could be possibly as soon as this weekend. And it wound up being that Sunday that it hit the news everywhere. Joe Biden not going to be going for re-election, and we're like, wow. So, John, as you said earlier, we were talking a few minutes ago. It seems like a year ago. I mean, so much has happened in the last 3 months since that announcement. I can't believe the last time we had Jan, he was still the presumptive Democratic nominee for 24. So it's amazing. So.
I also keep forgetting that he's still around. He's still the president. I forget that sometimes.
I forget that too. And I think there's been such a shift in focus on her and the campaign that, he's still the commander in chief till January 21st. So there's that. But I know we look forward to hearing what you guys have to say on that. I know there was a rate cut since the last time we talked to you guys. And, you guys had mentioned that you definitely thought one was coming at some point early in the fall or late summer. And it did happen, obviously, in September. So, we were looking forward to getting your outlook on all that stuff. So thanks. Great to have you guys.
Excellent. Well, thanks again for hosting us. And thanks, everybody, for joining the call. Let's start with the Fed and we'll go through some of the other major topics. I think our position was that the Fed should start cutting in July and that when they sat on their hands in July, that they should do a makeup 50 basis points. But we didn't think they would, and in the end, they surprised us. I think positively, we were advocating that the Fed should have gotten started earlier and been able to go at 25 basis point clips. We think that that's where they settle in right now into that pace for the coming meetings. We saw that 50 basis points in July as kind of a makeup cut. I mean, in September as a makeup cut for July. Looking at the minutes, pretty clear that there's a diversity of opinion on the committee about whether they should have started with that 50 basis points. It looks like we agree with the analyst's assessment that the minutes make it sound like Chair Powell got his way with that one. And over the next coming meetings, we think that the data is. We saw some encouraging data today. We saw some, but it's been a mixed bag, and we think that amid the garbled signals on the economy to some extent, that the Fed is going to proceed on the easing path, but cautiously. And so we think that suggests a 25 basis point cadence for the coming meetings, and the Fed can justify this not by sitting there and looking at cherry picking the strong data or something like that. They can I think that the Fed is perfectly capable of characterizing this as adjustment of the very tight and high real interest rate environment, and they're recalibrating. This is not easing doesn't mean easy. And this is the kind of formulation that we think that the Fed takes for the foreseeable couple of meetings here, and then take stock after the election. I think in December, you get one more in December, 25 basis point kind of automatic, and then reassess in the new year. We think that the Fed is going to be able to continue with that 25 basis point cadence. We think that the uptick in inflation over the medium to longer term, our base case is still that the U.S. economy is going to be relatively softer. We've been very impressed with the fortitude of the U.S. consumer, but that the undertone of price pressures, we'll get into sort of oil prices and so forth. There's just that degree of stickiness as you get down to this level that we think keeps the economy in. I mean, stagflation is probably a little bit of an overstatement, but sort of stagflation light is our outlook for the coming year, which allows the Fed to be cutting 25 basis points, for into sort of into the spring and early summer, and relatively comfortably. The idea of a reacceleration, we can talk a little bit about that. Some of that obviously depends on the policy mix of the incoming administration, but our base case is that the Fed is kind of not on autopilot, but is going to be at a pretty steady 25 basis point cadence for the coming meetings, and looking ahead to softer but a higher equilibrium than pre-COVID of inflation. And despite the good-looking retail sales numbers, some signs of consumer fatigue, particularly in the lower income echelons.
Yeah, I think the debate within the Fed is not you're going to get 25 for a while. The date really is they want to normalize rates. They call it the R squared, but it's what the neutral rate is. I think that's the debate to focus on, not whether it's going to be 25 at each meeting. It's where do we end up? Is it 3, 3.5, 4? And when you look at the dot plot, it's clear that a lot of the FOMC members have very divergent views on where the neutral rate should be for this. We call it an easing cycle, but really what they want to kind of call it is a normalization cycle.
Mm-hmm.
And amid the as we mentioned, the veil of uncertainty here that the election represents, I think is one of the things that will keep the Fed guessing, at least for the near future here. And on the other side of the election, we can see very divergent policy outcomes. And we talked a little bit about this last time. President Biden was still the nominee, and at that time, our view going into the debate was that Biden would squeak past, and you'd have a divided Congress with a second Biden term. We're continuing to call for a divided Congress, and we think that currently, based on the polls, we think that Harris-Walz has a slightly better chance than Trump to get through to get to 270 with the Electoral College math. But it's a really tight election. It's a margin of error kind of race. We think that polling is a very impaired science in the current environment. So a lot of people are looking to the betting markets and the prediction markets. I think we've all seen, a lot of us have been paying attention to like Polymarket and some of these others, which are showing like this dramatic shift. So it's now like 60-40 in favor of Trump. And, there are sort of two schools of thought on this, which is, prediction markets are, because people are putting real money on the line, they just have, they're going to be more accurate than these, dialing up, and calling people and trying to get some sort of answer. So, markets are the wisdom of crowds, right? You're going to get the markets are going to be the first to sniff these out. The sort of skeptical eye would be, markets are wrong all the time. And prediction markets aren't very deep, and they can, we saw going into Brexit, for instance, all the bookies in the UK had, the odds were mostly skewed pretty heavily in terms of no Brexit. And so they're not infallible. They are, relatively shallow markets. If you're looking for efficient markets, look at the Treasury market rather than poly markets. And Wall Street just doesn't have a great track record of predicting political outcomes. Now, if there's something certainly like within the political circles in DC, there isn't anything overtly clear that you would point to and say, well, that is obviously that event is causing the divergence in these causing the betting markets and the prediction markets to diverge so dramatically from the polls themselves. There isn't any single event you can point to. Harris hasn't face planted in any debates like Biden did. So it is definitely it's something that is intriguing. And I think, your interpretation of that, probably says a lot about, the way that you're sort of framing the election in general. Being down in DC, it's hard to look at poly markets, 60-40 and link that to anything that sort of the professional pollsters, forecasters, and just the vibes around the election are indicating. But, it's a very, very challenging thing to predict. So, you can certainly look at the equity market and say, you can see the fingerprints of the Trump trade, right? Like ExxonMobil and the energy stocks doing really well. You can see, banks benefiting, from a deregulatory, hopes of a deregulatory environment under a Trump administration. The obviously everybody looks at the DJT, Truth Social stock, which has sort of popped here. I guess it's coming back a little bit. The press narrative has definitely been along the lines of, Harris's post-debate bump. The honeymoon's over. I think the press is just bored. I think that they're just trying to figure out some sort of narrative that will get eyeballs between now and Harris steadily, like a tied race that doesn't seem to be moving all that much isn't something that they can write about. And so our sense is that amid all this, if you have to bet and we have to bet, then we would still bet on a very narrow victory by Harris-Walz, where they don't take the Senate, and you end up with we think that that's a pretty low volatility outcome, right? The concerns about the left-leaning policies, higher taxes, and so forth. Good luck getting that through a Republican-controlled Senate. And the idea that they would be focused on trying to deal with the immigration issue, which is something that the White House can deal with, and then just try to make the case that that their policies are better and try to get the midterms going in their direction. But I think that's a relatively friendly market outcome. I think that you can look at the equity market and say the equity market may be sniffing out a Trump victory. It doesn't look as much like the Treasury market is sniffing out a Trump victory. A very stimulative and potentially inflationary kind of dynamic that, Trump, if he wins the second term, he would almost certainly have the Senate and the House come with him, and straight line path to, pretty significant tax cuts, deregulatory stance, and so forth. Obviously would take the mandate on immigration, and, whether it's, it's that would tend to tighten the labor market. Obviously tariffs, there's a sense, among, certainly on Wall Street and a lot of other places, that his threats on tariffs are more a bargaining position rather than a, set in stone, and something that he's clearly committed to. But, he does believe in tariffs. He put them on in his first term, and one would assume that at least some of those tariffs would be in place, and with an inflationary effect. And he's not a fiscal conservative. He's a stimulus growth guy, and so the bond market doesn't seem to be in line as overtly, I would think, with sort of a Trump win. And obviously we'll see how price action plays out over the next couple over the next couple of weeks. So obviously the Fed isn't going to be isn't going to be political in their decision making, but they're going to have to take into account a policy mix on a going forward basis. And I think our Trump versus Harris outcome for the Fed isn't all that different, but you might see the Fed with less ability to put their foot on the gas if you have a very stimulative fiscal policy set up under a second Trump term. Let's see.
We had the ECB today.
Yeah, we think the European Central Bank has communicated pretty well on rates. They got an earlier start. They're not on autopilot. They don't have they don't have as big a sort of stagflationary issue as maybe the UK, for instance. Although UK's at least headline inflation numbers came in looking a little bit better than expected this week. And we think that the idea that that the ECB has been talking about normalization, has been creating this relatively shallow path of easing, has been appropriate, and we think that the Fed is gonna follow that kind of playbook. Obviously, when it comes to the European Central Bank, they might find themselves in a more challenging position vis-a-vis the United States on the trade front. We saw that happen during the Trump first administration, and that would tend to put the ECB in more of an easing mode. We think that probably some of their reticence currently is about keeping their powder dry, just in case they have to deploy more easing to balance, let's say, tariffs on EU cars and so forth. So there's whatever market you're in around the world, major market you're in around the world, obviously there's that veil of uncertainty around the U.S. election, and we think that policy decisions are going to be tentative ahead of that. In Japan, another central bank that has expressed themselves pretty clearly, but in a very different way. Our view is that the Bank of Japan was not covered by accolades in their rate hike in late July, and the incoming prime minister has quite overtly weighed in on his view that the Bank of Japan should sit tight, and we think that's what the Bank of Japan does, and sits on its hands till the end of the year, in December, get past the election, assess the economic situation, and we think overall the economic situation is going to be softer around the world into year end. We don't see a dramatic reacceleration of or sources of reacceleration of global growth. One would have to look at that are dramatic. We think that China obviously would be the place you would look if you were going to see one government around the world able to really elevate the reflationary dynamic around the world, and we count ourselves and continue to be in the skeptics camp. Our longstanding, and I think that's a bit of a broken record, to be honest, view on China is like sell all rallies. It's a structural mess. It's a dead market. It's a mean reverting equity market. It pops on stimulus announcements and then basically sells off as the follow through in policy implementation doesn't yield the impact in the real economy that everybody had hoped. And so we're seeing that very much play out. The pop and drop dynamic is very much in effect in Chinese markets. The last few announcements about the character of the fiscal spending, these are the headline numbers that have been bandied about. in some of these in some of these press conferences and so forth seem big, but there's a lot of question about the deployment of them. And so much of the focus being on stabilizing the property sector, which is like throwing money into a flaming garbage barrel at this point, right? It's a money destruction machine. Whereas, putting money in consumers' pockets would have a lot more impact, we think. And so you can see whether you're looking at iron ore, whether you're looking at copper, those traditional bellwethers of China's property market rebound had that same kind of pop and drop dynamic, and they're well into the rollover phase. The more official announcements on fiscal stimulus are expected to come out maybe the end of this month, and perhaps get some more through the end of the year. But the big 2008 bazooka, the era of the 4 trillion fresh money dropped into the helicopter dropped into the economy. We don't think that's coming. So our expectation is that the Chinese property market, they have to spend more money to keep run faster to stand still, spend more money to stand still. They're staving off a worst case scenario rather than actually like reigniting the engines. And I think that the market reaction is pretty consistent with that. It's not that encouraging a picture, but it's better than it's better than the property market tumbling down. The Chinese economy is not in great shape. And that's not particularly helpful in terms of the geopolitical situation. Years and years and years ago, and Brendan and I were still at the hedge fund when Xi Jinping was coming in, the thesis that we had in house was that that President Xi would have to derive his legitimacy from nationalism, because the growth and enriching and wealth generation of that had really set the validity of the rule of his predecessors was going to be coming to an end. And the more the longer the Chinese economy sort of stays in the tank, the more legitimacy that Xi has to draw from that nationalism card. We're seeing some the headlines around Taiwan, the exercises, the maneuvers, the sort of dry run for a blockade. We don't think that that's something that is, in immediate and clear and present danger, but it's, one of these risks out on the tail that, that obviously you have to keep at least, part of an eye on from time to time. So our excitement, our level of excitement on China is still in sort of curb your enthusiasm phase, and we think that it's playing out to the script that we've seen before in recent episodes of Chinese stimulus. Oil prices, if you told us all a few years ago like what was going on in the Middle East, and you asked us to guess where oil prices were, I probably wouldn't have guessed. I probably would have guessed at least $30 higher than right now. The Biden administration isn't exactly crowing about their about U.S. Production, but the U.S. production is going great, and the Saudis are going ahead with the essentially leading the rollback of OPEC production curbs, and that in the grand scheme of where we are in the Middle East, we're not geopolitical experts by any stretch of the imagination, but the Saudis appear to be playing ball, and to the extent that what Israel is doing is degrading the Iran's proxies throughout the region. And the headlines that B-2 bombers dumped a bunch of ordnance on the Houthis in Yemen. That's that's the kind of thing that the Saudis surely got forewarned about and gave the thumbs up for. This is it's a tinderbox. It's a very fluid situation. It certainly looks as though whenever there's an Israeli escalation, the response from Tehran is some sort of orchestrated retaliation, stage managed retaliation, combined with basically back channels, communications about wanting to de-escalate. I think that Netanyahu sees that as a as a sign of weakness and a green light to keep pushing his current advantage, and to try to roll up as many of these Hezbollah and Hamas fighters as he can, Houthis as well, without without really lighting the candle and going after Iranian oil fields, going after Iranian nuclear reactors and so forth, but obviously reserving the right down the road to do so. So it's obviously it's a very challenging and ugly situation in these theaters, but it certainly looks as though one side has the initiative, and that is the Israeli American / Saudi, and we'll see what happens next. And the oil price is really, the stability of oil prices is just, I think, a testament to that alignment and mutual understanding. Let's see, in terms of other things going on around the globe. Yeah, I mean, in terms of the, sort of the talking about the Trump trade and so forth, we mentioned that the banks are doing well, but the banks are doing well for a variety of reasons, one of them being earnings. And so, Brendan, what are you seeing in the bank earnings and some of the other earnings reports that have come out so far?
Yeah, I mean, both, individually, the trading was up, so it was a strong quarter for a lot of the investment banks, but the traditional banks are, still seeing a relatively strong consumer. The low end of the consumer is starting to see some, pressure, but overall, the economy and the consumer seems to be pretty strong, and net interest margins are staying steady, so not a bad scenario for the banks.
Let's see, and one last tidbit. One of the things that we've seen in Washington, D.C. over the last couple of years is an understanding in not just the political classes, but the sort of policy bedrock, the career staff and so forth at various agencies and in the White House, that policy decisions in the U.S. Have a hard time translating evenly into funding decisions by the various funding arms of the government. And so I think there's been some distinct frustration among Biden officials that Inflation Reduction Act and bipartisan infrastructure spending is going forward and more in red states where permitting is easier, and so it's not really helping them politically the way that they wanted to. And so there's an increased, it seems to us that, when you look at government, when you look at the way that government operates, from the outside looking in, I always tended as an analyst at a hedge fund to, ask policymakers like, what are you thinking about this policy, and so on and so forth, and assessing them on that kind of grading them on how they discussed a particular policy to see how serious they would be about it. When you go into government, like I did and worked at the Treasury Department, nobody assesses the seriousness of a government initiative by how cogently people talk about it. It's all about personnel. It's about, how serious are they about it? You can tell because they put top people on it. Ambitious staffers are attracted to it. They've got a growing budget. They've got a bigger, brighter, sunnier office. They're moving into parts of the building that other offices wish they were in. And so, personnel is policy in a very important way. Budget is policy. It shows, you can think of, an entity like the Treasury and see sort of a heat map, right? And certain offices are hot, right? They're the ones that, the go-getters are going to, and the bureaucrats that want a more leisurely life are drifting off into other offices that are more of, lower policy priorities. One of the policy priorities that we can, and we can see this happening around this issue of deployment of capital and the red tape and disconnect between policy decisions and capital decisions. And that, when you look at Exim Bank, when you look at the Development Finance Corporation, you look at DoD and other funding arms, they're trying to think creatively, and they're thinking on Capitol Hill creatively about legislation that can help facilitate this, so that policy decisions translate more directly into deployment of capital. And it's corruption, fraud, waste, and abuse obviously is something that they want to avoid. But the U.S. government has been in a position where they would give up $1 trillion of benefit to prevent $1 million, in waste. It's a gross oversimplification, but that's the kind of the no cylinders mindset has I think pervaded some of these organizations and made deployment of capital. That's why there are headlines about the U.S. Starting a sovereign wealth fund. Why would the U.S. aren't sovereign wealth funds for countries with like extra capital lying around? It's not like the U.S. has that, but why would they want one? Well, the reason they would want one is because they want an entity that's able to make funding decisions that are aligned with policy and more closely. So I think that's obviously that's a long-term issue, but it's something to watch, and it's something that the Trump administration I think has a maybe an easier time. Putting together, but it's not as though the sort of Biden-Harris administration are ignoring this issue either. I think it's going to be something that is, pretty salient over the coming, this is a policy, so it's more like, 4-year clips over the next 4, 8, 12 years. So watch this space.
One thing that I found that I definitely wanted to ask you guys about, that we started hearing, as obviously we see that Harris is going to be running, and we started hearing maybe a little bit about policy. The idea or the concept of taxing unrealized capital gains was floated about, and I think when this first kind of was discussed, it was like, whoa, and we're all in the investment community. What does this mean? What does this mean for us? Then we started hearing, oh no, that's just going to be more at the billionaire class. I mean, what is your take on the seriousness of them trying to get that through on taxing unrealized capital gains? And have you heard anything about where they would draw that line of income at, or how would you determine who would be subject to that? Or is it just more saber rattling, like, hey, we're going to go after the rich, trying to get that kind of populist? What is your whole take on that from a political standpoint?
Yeah, my personal view is it's completely unworkable, and they would never ever be able to get it done. I don't think that the Harris campaign is completely backed off that. I don't think she's mentioned it. I think it's something that is like a pipe dream of a certain pocket of the relatively far left of the party. You get some people that throw that idea into the mix, and I think it's completely unworkable. If you put it in front of the tax people at Treasury, their heads would explode. Their heads have already exploded over this this policy being put out there. It would be extremely difficult to implement on just like a tax basis. It would also be thunderously difficult to get through even a Democrat-controlled Congress, right? You would get the Democrats still have a lot of centrists, and they from rich states like Connecticut and New Jersey and so forth, and New York, that would absolutely never sign on for something like this. I think it's I think that the Harris administration doesn't really get like how poisonous this idea is, and and I think that basically like publicly repudiating it isn't like great politics, because they don't want to seem like they're kowtowing to the billionaire class. But I think it's like never say 0%, but it's as close to zero, I think, as you can possibly get, both in like the the ability to even legislate something like that, and the ability to have it be, in any way like operationally workable. So that I think it's, I don't want to there are a lot of things that, you know, the sort of the Harris Walls campaign, they've got a lot of priorities other than sort of dissuading people from believing that that's coming. But I think it's definitely, I think it's a complete fringe idea.
Yeah, and you would think, you know, that was something we heard. Probably they floated back in August when she kind of was first taken over, late July, and you know, since then she's kind of moved to the center as you would expect before a general election. You know, not for banning fracking now, or the fact that she mentioned she owns a gun. So it's weird because that taxing unrealized capital gains is something like you just said would appeal maybe to the more extreme left. I mean, everybody else, people, we all have unrealized capital gains, our houses, our stock portfolios. Then we started hearing chatter, oh, it's only going to be for billionaires. Well, you didn't say that originally. So, yeah, I just wanted your guys' perspective on that. It's kind of what I thought. And we sure aren't rooting for that in our industry. So,
Yeah, I don't think it's in any way a serious policy proposal. I just
okay.
don't.
Okay, good deal. All right, let's see if we have any more questions. That was definitely a good one. That's really I think that's about all the questions we have, or don't have too much today. I think you guys, as usual, covered so much. Looking at the geopolitical risks, you know, you did mention there definitely, with what's going on with Israel, Iran, Palestine. You mentioned China, the potential China-Taiwan situation. We heard about destabilization between North and South Korea. There is a little bit of riskiness going on, right? I mean,
Yeah.
no. So I think whoever is in the presidency, you know, come January, is going to have their work cut out for them as far as just the geopolitical landscape. And but we really appreciate having you guys on and helping us navigate that. And yeah, it's something that people need to look at is how the big picture affects the markets that we invest in. No question at all.
Well,
So,
thanks. It's great to be back with you, Ed. And yeah, for anybody listening, you can find us at marketspolicy.com. And we have a podcast, the Macrocast, which you can find on Apple Podcasts as well, and listen to us. You know, have some special guests on, and our other co-host, Ed Hill, is a veteran of Washington D.C., so always full of insights. So.
All right, that sounds great. Well, thank you, John. Thank you, Brendan. Appreciate it very much. And for our clients out there that have joined us, I appreciate you taking your time out of your day today. This was a fantastic call, and we will be in touch with you for who we might be having on come November. I don't know if that's settled yet, what we're going to be having, but we'll reach out to you soon. And as John mentioned, you can go to their website or reach out to your CAPIS sales rep or whoever invited you onto this call. We can get you in touch with Markets Policy Partners and see if you want to have more of a one-on-one relationship, and they can help you navigate as far as your portfolio is concerned. So, but thank you. All right. Appreciate it, everyone. Until next time, have a great day.